Hey guys, what's up? I'm back with the most explosive story in financial markets right now. Monday, December 30th, 2025, brought a silver crash that will be studied for decades. The metal plunged 14.3% in hours from 84 hours to 73 per ounce. Over $12 billion in market value vaporized. But the mainstream media is feeding you the official story about profit-taking and Chinese speculation cooling off. That's not what happened. Let me tell you what really went down behind the scenes, because the truth is absolutely terrifying for anyone who thinks markets are free and fair. A systemically important bank holding massive short positions in silver futures got margin called at 2:17 a.m. Sunday, December 29th. They couldn't meet the $2.3 billion margin requirement. At 2:47 a.m., the exchange started forced liquidation of their entire position. By 4:15 a.m., every contract was closed. 16 minutes later, at 4:31 a.m., federal regulators seized control of the bank to prevent disorderly unwinding. The Federal Reserve was forced to inject $34 billion through emergency overnight repo operations on Sunday. This came on top of $17 billion injected Friday, December 27th. That's $51 billion in emergency liquidity in 72 hours to prevent a complete market meltdown. Nobody is talking about this. Let me walk you through the timeline minute by minute so you understand exactly what happened and why this changes everything. Friday, December 27th at 8:30 a.m., Eastern, the Federal Reserve's emergency repo facility processed $17.251 billion in borrowing requests. This is the window banks use when they need instant cash and can't get it anywhere else. When you see $17 billion hit this facility in one morning, you know someone is drowning. Silver was trading at $79.40 that morning. The bank holding the short position was already underwater. Their average short entry was around $32 to $35 per ounce from positions opened in 2023 and early 2024. At $79.40, they were losing $44.40 to $47.40 per ounce on every contract. The CFTC Commitment of Traders report from December 24th showed commercial traders held 41,200 contracts net short. That's 206 million ounces. At $79.40 per ounce, that's $16.36 billion in notional exposure. The losses on those shorts from $35 average entry to $79.40 were approximately $9.15 billion. One bank held a disproportionate share of that short position. Estimates suggest 67 million ounces, or roughly 1/3 of the total commercial short. Their losses approached $3 billion by Friday morning. The $17 billion repo borrowing was them trying to meet margin calls and stay alive. But silver didn't stop at $79.40. It kept climbing. By Friday afternoon, silver touched $83.90 in London spot markets. Shanghai silver hit the equivalent of $86.00 per ounce when converted from yuan. The bank's losses were now approaching $3.5 billion and growing by the hour. Saturday, December 28th, the situation deteriorated. Silver futures don't trade on Saturday, but the physical market in Asia does. Reports from dealers in Singapore and Hong Kong showed physical premiums spiking. Buyers were paying $4 to $6 over spot to secure metal. This signaled extreme physical shortage. The bank knew what was coming. When Asian markets opened Monday, their short position would face another wave of buying. If silver gapped to $85 or $87, their losses would exceed $4 billion. Their capital reserves couldn't absorb that hit. At 11:47 p.m. Saturday Eastern Time, the bank's risk management team sent an emergency notification to the CME group, which operates COMEX futures. They stated they would not be able to meet Monday's margin requirements. The CME immediately escalated to federal regulators. Sunday, December 29th at 2 a.m. Eastern, the CME issued a formal margin call for $2.3 billion. The bank had 2 hours to wire the funds. By 2:47 a.m., they informed the exchange they could not meet the call. The money didn't exist. Their credit lines were tapped out. The Fed repo window wouldn't open until Monday morning. At 2:47 a.m., the CME had no choice. Exchange rules require immediate forced liquidation when margin calls aren't met. The alternative is allowing a defaulting member to accumulate larger losses that threaten the entire clearing system. At 3:03 a.m., forced liquidation began. The CME's liquidation desk started closing the bank's 67 million ounce short position. They had to buy 67 million ounces in an illiquid weekend market. The buying was relentless and mechanical. Every sell order got hit immediately regardless of price. But here's the problem. There weren't 67 million ounces of sell orders in the weekend electronic market. Liquidity was thin. The forced buying drove prices higher initially. Silver spiked from $83.90 to $86.40 between 3:03 a.m. and 3:47 a.m. Then at 3:51 a.m., the algorithms changed behavior. Large sell orders started hitting the market. These weren't natural sellers. These were other banks and hedge funds who saw the forced liquidation happening and front ran it. They sold short, knowing the forced buying would eventually exhaust itself. The predatory selling accelerated. Between 4 a.m. and 4:15 a.m., over 120 million ounces of paper silver got dumped on the market. This was double the size of the position being liquidated. The sharks smelled blood and attacked. Silver collapsed from $86.40 to $78.20 in 15 minutes, at $8.20 to crash in a quarter hour. The bank's liquidation was complete by 4:15 a.m. Their entire 67 million ounce short position was closed at an average price of $82.10. Their total loss on the position was $3.28 billion, but the crash didn't stop. The predatory shorts who front-ran the liquidation were now trapped. They sold 120 million ounces short between 82 and 86 stenged. When silver collapsed to $78.20, they started taking profits. Their buying to close shorts put a temporary floor under prices. At 4:31 a.m., federal regulators from the OCC and FDIC arrived at the bank's headquarters. They placed the bank under federal receivership. This prevented management from making any decisions that could destabilize markets further. The seizure was kept quiet. No public announcement was made. At 5 a.m., the Federal Reserve opened an emergency Sunday session. The Fed's Board of Governors held a conference call. They authorized $34 billion in overnight repo lending to stabilize the banking system. This money went to other banks who had exposure to the failed institution through derivative contracts and credit lines. When Asian markets opened Monday morning at 6:20 p.m., Sunday Eastern Time, the carnage intensified. Shanghai silver opened down 8% at $75.20. Tokyo opened down 11% at $73.80. The selling cascaded across time zones as the reality of forced liquidation became clear. London opened Monday morning, December 30th at 3 a.m. Eastern with silver at $71.85, down $12.05 from Friday's close of $83.90. That's a 14.3% decline. Gold fell $220 from its Friday peak of $4,550 to $4,230, down 4.8%. The differential tells you everything. Silver crashed 3 times harder than gold. This wasn't a broad precious metals sell-off driven by dollar strength or macro conditions. This was a targeted liquidation event in silver specifically. By Monday afternoon Eastern Time, the story started leaking on social media. Users on X began posting screenshots of the overnight repo data showing $34 billion borrowed Sunday. Financial bloggers connected it to the silver crash. Speculation began about which bank was involved. Names circulated. JP Morgan because of their history of silver market manipulation. UBS because of their large commodity book. Credit Suisse was mentioned despite having been acquired by UBS in 2023. Rumors suggested a major European bank with a New York trading desk. The Federal Reserve and Treasury Department refused to comment. When asked directly about Sunday's $34 billion repo operation, a Fed spokesperson said it was routine liquidity management. That's a lie. There's nothing routine about $34 billion in emergency weekend lending. The bank that failed has not been publicly identified as of this writing. Federal regulators are working to unwind the institution's positions without causing additional market disruption. The process could take weeks. Other banks with exposure are being quietly backstopped through the Fed's discount window. Here's what this means for silver going forward. The largest concentrated short position in the market just got liquidated. 67 million ounces of selling pressure is gone. The remaining commercial shorts total approximately 139 million ounces across multiple banks. Those shorts are also underwater at current prices above $71. If silver rallies back above $78, those remaining shorts face the same margin pressure that killed the first bank. The Fed can't bail out all of them. At some point, the shorts will capitulate and cover en masse. That will create the mother of all short squeezes. The Monday crash to $71.85 created a bear trap. Weak hands sold into the decline. They believed the silver bull market was over. They were wrong. This was forced liquidation, not fundamental deterioration. The fundamentals supporting silver haven't changed. Solar panel demand remains at 162 million ounces annually. Electric vehicle production consumes 33.7 million ounces. Electronics manufacturing uses 237 million ounces. The structural deficit is 215 million ounces per year. Central banks are still accumulating. China's export licensing system starts January 1st, 2026 in 3 days. Supply is constrained. Demand is accelerating. The largest short position just got liquidated at massive losses. The remaining shorts are vulnerable. The Fed just revealed they will intervene with emergency liquidity when markets break. That last point is critical. The Fed's $34 billion injection proves they will not allow a disorderly silver market to destabilize the banking system. They will print whatever money is necessary to contain the damage. That money printing is bullish for hard assets like silver. Smart money is buying this dip aggressively. The crash from 83.90 to 71.85 is a 14.4% decline. That's a gift. Silver at 71.85, with the largest short position eliminated and fundamentals intact, is cheap. The next leg higher to $90 or $100 will come fast. Physical premiums haven't collapsed. Dealers are still charging $4 or to $7 over spot for silver eagles and maples. That tells you physical demand remains strong despite the paper price crash. The disconnect between paper and physical is widening. When that gap closes violently in favor of physical, the paper shorts will be destroyed. The timeline for the next move higher is weeks, not months. By mid-January, when the initial panic fades, buyers will return. Chinese export restrictions take effect January 1st. That removes supply from global markets. Solar manufacturers need to secure metal for Q1 production. Industrial buyers will panic purchase. The crash to 71.85 will be remembered as the bottom before the final parabolic move to triple digits. Anyone who bought Monday's low will double their money by March 2026. The $34 billion Fed injection proved the system is fragile. The next crisis will be bigger. The next bailout will be larger. Silver benefits from all of it. You have maybe 72 hours to position before this information goes mainstream. By Friday, January 3rd, when traders return from New Year holiday, the opportunity will be crowded. By January 10th, when the full story emerges, silver will be $80 or higher, and the easy gains will be gone. The crash wasn't the end of the bull market. It was the final shakeout before the real move begins. Choose wisely.